For 37 years, Amigos has been owned and operated largely, well, by Janice and I. For 25 or 30 years, we had some other stockholders involved. We bought those other stockholders out in 2010. And now we're at a fork in the road. Well, we're past the fork in the road. In March, we became an employee stock ownership plan. So we're going down a all new ownership path. And essentially what we've done is we have sold our stock into the trust, and that stock over a period of time will be divvied up among the employees based on their comp. So ESOP, what does it stand for? Employee Stock Ownership Plan. Basically, first and foremost, it is a retirement plan that acquires a company stock for the benefit of the employees. It's a retirement plan. Please keep that right in the front of your head, because that's what this is. Shares are allocated to the employee account annually. Employees receive cash in exchange for their shares. Largely, for most people, it's when they retire, termination, disability, or death. But largely, it's retirement. We became 100% employee owned, and we became a sub-S corp. And the net result of that is our company now has a favorable tax situation. The ESOP and the sub-S remove the corporate tax burden, approximately 40 to 45%. So the money that we were paying to the government in taxes, for the short term, we will retire the debt that was taken on to do the ESOP, but in the long term, that debt's going to go away, and we can use that extra money to grow. And the growth of the company will grow your ESOP account.
So you might be wondering, well, are there other ESOPs out there? Maybe you've not heard a whole lot about ESOPs so far. There are about 6,700 ESOPs around the country, covering over 14 million employees. And most of those ESOPs are in privately held companies like Amigos. Of that 6,700 number, only about 2,500 of them are 100% owned by the ESOP like Amigos is now. And that number was actually less than 100 back in 1998. So you're probably wondering, well, what's driven the growth? How did we jump up from 100 to 2,500 within that period of time? And the answer goes back to some of the tax benefits that Roger was talking about. So Congress back in 1997 specifically put in the law that they wanted S-Corp ESOP companies to be able to operate tax-free. And it was really meant to encourage more people like Roger and Jan to think about the ESOP as an option instead of selling their company to a private equity company or to a competitor. There have been a number of studies out there done recently that's really tried to figure out, what difference does the ESOP make? Does it make a difference in how well that company performs or the longevity of that company? And so a recent one looked at ESOPs through the Great Recession. And it really showed a couple of different things. Number one is that ESOP companies were less likely during the recession to default on their debt. They stayed current on their debt. And they were also just more likely in general to survive the recession and make it through to the other side. And so I think that shows some of how employees who own their companies, how they can work together through times where the company may be facing challenges. So here is a map of some various ESOP companies around the country. Some of those names you may know, some of them you may not. One of the examples that Roger actually shared with me was a company called Winco Foods. And Winco Foods is a group of grocery stores headquartered in the Pacific Northwest. And the employees purchased that company back in 1986 for about $10 million. Today, those employees have shares valued at over $3 billion. So it's a tremendous amount of growth over that period of time. And so at their store in Oregon, the ESOP accounts for about 130 employees who work at that particular store. They have accounts valued at over $100 million. So you can do that math. It's not quite $1 million piece. But if you think about that, a lot of the people working in that store are people working in the grocery business, right? They're people who are out there stocking shelves, checking people out, bagging groceries. So an important thing to know is the ESOP has what we call an ESOP trustee. And basically that is a professional trustee whose job is to represent the best interest of the participants. That ESOP trustee is what we would call a fiduciary. And that's just a fancy word for saying someone who has a legal obligation to make the best decisions they can for somebody else. And so what we did when we went through and Roger and Jan sold their stock, we hired this trustee. He hired his own independent appraiser or valuation firm to value the company. And we negotiated with that trustee. So the important thing to know about that trustee is he knows a lot about ESOPs, but he really doesn't know a darn thing about running Amigos. He would do no better job than me at making crispy burritos. I'm pretty sure he'd be terrible. He's not nearly as good as you guys about knowing the restaurant business. But what he knows a whole lot about is ESOPs. ESOPs have a lot of rules from both the IRS, because we get a lot of tax benefits, so we have a lot of rules to follow. We also have rules from the Department of Labor. So it's his job to help keep us in compliance and to help us follow all the rules, but not to run the company. So when a ESOP borrows money to purchase stock, we call that a leveraged ESOP. And the slide that you have in front of you gives you an overview of what we did. The company borrowed money from the bank. In this case, it was First National Bank of Omaha. And the Bank of Omaha said, well, I'm not going to give you all the money for it. I'll give you some of it, a little down payment. And Roger and Jan have notes for the rest. So the company owes the bank, and the bank's going to get paid first. And after the bank gets paid, then we can start making payments to Roger and Jan. And it was the company who then loaned that money to the ESOP, which allowed the ESOP to buy the stock. We knew the employees didn't have money to buy it, so it's really the bank and Roger and Jan who are helping fund all this and make it happen. So now that those loans are in place, what's going to happen is that the company, as it generates cash flow, as you guys go to work every day and the stores make profit, we're going to use part of those profits to pay off the bank and then later to pay off Roger and Jan. The other thing that's going to happen is that every year the company's going to make a contribution to the ESOP. The ESOP is going to use that money to pay back some of the funds it borrowed from the company to be able to purchase that stock. And it's that payment on that loan to the ESOP that allows us to allocate or to put shares in the stock of employees. So what's the bottom line to all of that? Well, first, I want to make sure that we have pretty reasonable expectations. For those of you who got your first ESOP participant statement, you might have opened that up and been a little disappointed. You said, well, gosh, there's not a whole lot in there. It's not worth a whole lot. What's this? Why is Roger so excited? This doesn't look like a whole lot today. But the important thing to remember is that is normal where we are with a brand new ESOP. And we'll talk about why the value is as low as it is. But it's very normal when we're just starting out or just getting your first contributions that we would expect those values to be very low. But as the company grows and as we pay down our debt, and just the fact alone that we don't pay income taxes, as a company, you guys are automatically going to have a 40-cent advantage over any of your competitors because you get to keep that 40 cents and use it to help pay down the debt and grow the company. And your competitors don't have that advantage. Now, it is important to remember that we don't have any guarantees on the future of the company. Just like Roger and Jan, you've not had a guarantee on how well the company would do the past almost 30 years. You only made money if the company did well. Well, it's going to be that same way. We still all have to work together to make the company successful. And to the extent that you can, it's also important to save on your own for retirement. So whether that's through an IRA or a savings account, you don't want to count on just one source of income for your retirement. So In the valuation world, in the business world, there's a term that we call EBITDA. And that stands for earnings before interest, taxes, depreciation, and amortization. And for those of you who are not accounting majors, you say, what is that lady talking about? What is EBITDA? It's really just a fancy way for saying, how much cash do we make, right? At the end of the day, after we've paid off all of our expenses, we've paid Cisco and whoever else we have to pay our bills to, how much cash do we have left? That's our profit that's left over. So when the valuation firm looks at the company, they look at how much cash we're making, how much profit we have, and they subtract out the debt that we have to the bank and to Roger and Jan. So the way that we grow our stock price is really two things. We want to find ways to increase our EBITDA or our cash flow, and we also want to pay down our debt. How do we determine that value on an annual basis? Well, our trustee, who we talked about before, hires an independent valuation firm. And it's not a firm that's any way related to Roger or Jan. It's not related to BKD. It's called Aclaro. And they are really experts in valuing ESOP companies. So they are going to look at our cash flow. They're going to say, how much money did we make this year? Jackie, sitting over there. And they're going to say, well, Roger, how do you think next year? How are we going to do? What's our outlook look like? What's the market look like in Lincoln? What kind of new plans do you have for new stores? So they're going to look at some of those things. But then they're also going to look at things like the economy. What's going on in the economy? What's going on in the fast food business? There are going to be some things that we can't control, right? We couldn't control the Great Recession. If people stay home and they stop eating out and they stay home and they eat their own beans, we can't do a whole lot about some of those things, but there are definitely a lot of things that you can do. I'm sure a number of you are wondering what the future value of the company will be. And the answer is not even I can tell you that. I've seen a lot of ESOP companies. One thing we do know is that the value of that future stock is going to be directly tied to how profitable the company is, as well as our outlook for how we think the company is going to be doing the next 3 or 4 or 5 years, and also tied to what our levels of debt would be. I mean, it's possible that the value of the shares could go up, but it's also possible that we could have years where the value could go down. It's not necessarily going to be a nice level increase year over year. It's really going to be everybody's job to continue your efforts, which have made the company a success so far. I've put together an example to help us better understand how the company's debt impacts the stock value. So probably there are some of you that may own your own house or are dreaming about owning your own house. For the younger people, maybe your parents own a house. So let's just say, for example, that I go out and I find myself a cute little $100,000 home, but I don't have a down payment. So I go and I talk to my bank. Perhaps I talk to Nate at First National Bank of Omaha. And Nate and I we must be buddies, because Nate says, oh, Kara, you don't need a down payment. I'll give you a loan for the full $100,000. Now, in the real world, that doesn't happen very often. But here we have money from the bank, and primarily from Roger and Jan is what's making that possible. So at the end of the day, after I've signed away my life and my firstborn child to the mortgage company, and I have my great big pile of paper, what do I really have? Well, I've got a great house and I'm excited about it, but I sure owe the bank a lot of money. So my ending equity in that home is starting out at 0. So when you guys see your statements and you say, gosh, there's not a lot there, that's really the reason why. We've got a great company. Amigos has a great outlook. I've learned a lot about this company the last year and a half, and you guys are doing some neat things and some exciting things, making some good food and taking good care of customers, which is awesome. But we still owe the bank and Roger and Jan a lot of money, and it's that debt that really keeps that value very low in the beginning, but that is normal, and that's what we would expect. So let's just say in our example, 2018, I go to work every day. So for me, it's going to work every day, helping new companies form ESOPs. For you, it's helping people have a good day and have a good meal to eat. So let's say you go to work every day and you pay down that mortgage, and you've paid down your mortgage to $90,000. So at the end of the next year, you still have your house, You've paid down your mortgage, and now you have $10,000 worth of equity in that home. That's what we expect to see here at the company, right? As the company generates cash flow, we generate profit, we're going to use part of that profit to pay down that debt. And if everything else stayed equal, just paying down that debt alone, we should see our stock value go up next year if the company continues to perform. So let's roll it forward one more year to 2019. So here's where I tell you guys a little bit more about me. My hobby, when I get home from a long day of doing ESOPs and I get my little boy finally put to bed, he doesn't want to go to bed, but when I get him finally put to bed, the way that I relax is I put on HGTV. And what are they always doing on HGTV? Some kind of home remodel, some kind of improvement project. And I get so many good ideas. And I look at my husband and he's giving me the look that says, I don't want to do that. Please don't make me do that. I say, yes, we're going to do that. It's a great idea. Of course, I don't really know how to do any of those things, but he's really handy. So he's done a number of home improvement projects for me over the years. And the great thing about those projects is they improve the value of my home. So when we go to move and we resell our home, it's worth more than what we paid for it. So in my example, let's say that my $100,000 home is now a $110,000 home. And I still went to work every day and I paid down my mortgage more. So now my mortgage is down to 80. So what does that mean for our equity number? It means it jumps, right? We go from 0 to 10 and we jump up to 30. So it's a bigger increase because we did things to make our home worth more. So when I go back to Roger's examples about, right, controlling our food costs or knowing our customer's name and getting them maybe to come back a little bit more, when I do those things, what that translates into is more value within the company. It makes Amigos worth more than what we paid for it. And I pay down my debt. And it's those kind of things that are going to help your stock value grow more quickly. You will also be receiving what's called a summary plan description, which is more of a legal version of this. It's also done in question and answer format and is a really good resource for questions. Eventually, we will be distributing what's called a beneficiary designation form. The beneficiary designation form basically tells the company where you want your money to go if something were to happen to you. So we don't want to have to guess. We'd much rather tell us, right, whether you're designating a spouse, a child, a friend, whoever that might be. It's important to know that if you are married, the rules say that if you designate anyone other than your spouse, then your spouse has to consent in writing on that form that says, okay, I know that you're giving your dear Aunt Edna all of our money, and I'm okay with that. So just be aware when you're filling out that form that that's something that you do need to get signed and we will need to get returned to the company. You already have your 2016 ESOP statements, which is a good start. Once we get the tax reporting wrapped up for the ESOP and you say, Kara, I thought we didn't pay taxes. Do we still have to file taxes? The answer is yes. We still have to file taxes for the company and for the ESOP. And so once we get that final tax reporting done, we'll be distributing what's called a summary annual report, which is really not a lot of exciting stuff in there, but it does give you a summary of all the assets within the plan, the expenses of the plan, and that's a document that you're legally entitled to receive. So we will probably have that out within the next couple of months.